What if I told you trillions of dollars are about to change hands and most of it will vanish? And here's something wild. Over the next 20 years, $84 trillion, yep, trillion with a T, will change hands as baby boomers pass their fortunes down. And they call it the Great Wealth Transfer. But honestly, for some, it's more like a Great Wealth Vanishing Act. Because let's face it, most Americans would not know what to do if they received a large sum of money in one day. But this video is not just about what to do if you're a very fortunate person to receive such a large inheritance from your parents or grandparents, but what to do if you receive a large insurance claim or a settlement, or if you hit the $10 million jackpot at the slot machine in Las Vegas. Because here's the brutal truth. Most people blow it fast as Fergie blowing her national anthem at the NBA All-Star game in 2018. Just like 70% of lottery winners go broke within a few years. And it's not just lotto winners. Entrepreneurs, meme coin traders, or even trust fund babies fall into the same trap. Why? Because sudden wealth doesn't just fatten your bank account, it messes with your brain. And so, real talk, if $10 million magically appeared in your bank account today, what would you do? Get a yacht? Adopt a pet tiger? Buy gold-plated toilets? Tempting, right? As for me, I've made bad money decisions before. Max out credit cards, stupid car loans, the works. And let me tell you, being broke sucks. That's why if a windfall ever comes my way, I'll follow the 10 simple steps to manage my wealth. And trust me, this isn't your average boring financial advice. This is something you must know because you'll never know when tons of cash might suddenly land on your lap. Step number 1, tell no one. Here's the first rule of Fight Club.
You do not talk about Fight Club.
My strategy, keep it on the down low. I've seen too many people lose relationships and sanity by oversharing because you got people you didn't talk to for several years asking you for money. Your father-in-law, who didn't think you were good enough for his daughter, is all of a sudden treating you with respect. So here's exactly what I would do if I were single. I would tell no one, not even my dog, because let's face it, they can't keep a secret either. My dog will be sitting in the business class with me, flying from LA to Singapore, and he's gonna bark he's rich in 10 different languages.
I'm rich. Stupid rich.
And I would keep living my life as if nothing happened. No sudden upgrades to my lifestyle, no flashy purchases, no Instagram posts showing off my new Rolex. Why? Because the moment people smell money, the requests start rolling in. And if you're married, you should tell your husband or wife. And if you tell me that's a bad idea in the comment section, then you're either single with a bad experience with your previous marriage, or you have a spouse you cannot trust. Then you're already in a bad marriage. And this isn't something that you can keep a secret from your spouse. If you don't think you should share this with your spouse, then I don't even know why you're married in the first place. Now that we got the secrecy part down, let's talk about something equally thrilling, and that's hiring a team of trusted professionals. So step number 2, I would quietly assemble a team of trusted professionals, a financial consultant, a tax expert, and an estate attorney. These are the only people who need to know the details because you want to have a portion of your large sum of money invested so that it can continue to grow and not get blown. You also want to have a tax expert to make sure Uncle Sam can collect a portion of your winnings. That's right. The government is going to want a piece of it. And you want an estate attorney to ensure your wealth is protected if something happens to you. A financial consultant or financial advisor needs to be a fiduciary advisor who puts your needs above their wants. I always recommend a fee-based advisor instead of a commission-based advisor. So essentially, this person is your accountability partner who is going to help you not blow all your money on black at the roulette table, thinking that you could double your money. And you're going to need someone to make sure you have the plan laid out for you. And having a tax professional is just as vital to ensure the longevity of your large payout. Because here's the thing, when you come into a windfall, the tax man will come knocking. And if you think you can outsmart the IRS, think again. They have a 90.6% conviction rate for tax crimes. Every year, thousands of people try to dodge taxes, and the IRS doesn't just send angry letters. They send people to federal prison. In 2022 alone, the IRS launched 2,550 criminal tax investigations, leading to 1,837 prosecutions and an average prison sentence of 37 months. And if you're caught hiding income, You could face fines up to $250,000 because nothing says bad investment like paying off the government and losing your freedom. And having an estate attorney is going to help you avoid probate, protect your assets, and minimize estate taxes. You also want to ensure your beneficiaries receive assets efficiently through a trust. Having a living trust is going to prevent your family members or random strangers fighting over your assets in a probate court if you pass away too soon. And let me ask you this: do you want your assets to be public information? If the answer is no, then go get yourself an estate attorney. And step number 3 is assess your primary income, but do not leave your job yet. Yes, that's right. Most people leave their jobs the second they get rich. Why? Because sudden wealth feels like winning the game. You cash in, walk away, and finally live the dream. But what happens next? That's where things go sideways. You don't want to become Peter Griffin when he quit his job right after winning the lottery.
Peter, what are you doing here?
I quit my job, Lois.
You what?
Yeah, we're rich now. I don't need to be working.
Without structure, without a plan, money disappears fast. It's like jumping out of a plane without checking your parachute. Sure, you've got cash, but 6 months later, you're wondering how you managed to burn through half of it on impulse buys, bad investments, and just this once splurges that never actually stopped. You may hate your job, but it's the one thing that's keeping you stable while you figure out how to handle this new reality. It buys you time to set up a financial plan, pay off debts, and decide what you really want in the long term. That's what keeps you from making the same mistakes that turn lottery winners into cautionary tales. Now, if I suddenly had $10 million, I wouldn't quit, at least not right away. I would take a step back, work with a financial advisor, and make sure every dollar had a purpose before making any big moves. Because here's the truth: getting rich doesn't mean you're set for life. Without a plan, you can lose it all just as fast as you got it. And since we're talking about planning, let's tackle the first thing that's probably eating away at your wealth. Step number 4 is to pay off your high interest debt. You see, debt is like the one friend who always borrows money and never pays you back. And except worse, because it charges interest and never forgets. Credit cards, personal loans, car loans, if it's got a high interest rate, it's draining your wealth faster than a leaky bucket in a rainstorm. So here's a hard truth: Americans collectively owe over $1.17 trillion in credit card debt, and the average credit card interest rate is now a brutal 22%. That means if you're carrying a balance, you're not just paying for past purchases, you're basically funding the bank's next skyscraper. And I should know because I've been there. And let me tell you about my 5 maxed out credit cards. Back in the day, I was living like I had it all and buying rounds of drinks, trying to impress everyone, and pretending I wasn't drowning in debt. But in reality, I was so broke that I had to split bar tabs across 2 credit cards because I knew one would get declined. Yeah, it was really that bad. So when I finally decided to turn things around, the first thing I did was tackle those credit cards. You don't even need a financial advisor to tell you that. You can do it on your own. And I made paying off my credit cards my top priority. Why? Because that 22% interest was like a financial vampire sucking the life out of my wallet every month. But it wasn't just about clearing debt. It was about breaking free from the cycle of living paycheck to paycheck. And let me tell you, the day I made the final payment, I felt so much better than any round of drinks I ever bought. Now, if you're in your 50s, it might be time to wipe out that mortgage, which is simply another form of debt. It's just specifically tied to real estate, where your home acts as collateral. See, the core idea is the same. You owe money, and how you manage it can make or break your financial future. And nothing screams financial freedom like owning your home outright. No mortgage, no monthly payments. Instead of sending money to the bank every single month, you get to keep it, invest it, and build even more wealth. And to me, that is the real essence of winning. Moving forward, it's time to talk about savings. And no, I don't mean stuffing cash under your mattress, because last I checked, mattresses, they don't pay interest. High yield savings accounts, on the other hand, now we're talking. So step number 5 is to build a cash reserve. First, you want to open up a private wealth checking account with the most trusted bank that is too big to fail. They can open what's called a cash management account, or CMA, and it's pretty popular among high net worth individuals because a CMA comes with a debit card and ATM access, and it extends FDIC coverage limits by putting additional deposits into partner banks. Keep in mind that a CMA acts as a brokerage account and not a bank account. It's like a facilitator between investment and cash accounts. And when you open a CMA, you can generally choose two options. The first option is to put your cash in a money market fund with a high yield return. But remember that the money market mutual funds are not eligible for FDIC insurance, but are eligible for SIPC coverage. So the SIPC protects customers' cash and securities up to $500,000 if their brokerage firm fails. The second option is to deposit your sizable cash in what's called a deposit sweep program if you need a higher limit on the FDIC insurance. So the deposits you sweep your cash into this program will spread your money around to several different banks that are participating in this program on your behalf. So at a minimum, there are 20 banks available to accept these cash deposits for up to $5 million of FDIC insurance. If you're married, then that's $10 million of FDIC coverage over 20 participating banks. So if you need more than $250,000 in FDIC coverage, you can choose this option to spread the money around for you so that you're not limited to the $250,000 FDIC limit. The only downside is that the APY for this account generally pays less than the money market fund. But no matter what your net worth is, you should always have an emergency fund. You're probably thinking, why in the world do I need an emergency fund if I had $10 million? It's the stock market volatility. You need to set aside liquidity so that you don't touch your investments when the market drops 5, 10, 15, or even 20% in 1 year. You also want to have some liquidity to get into the stock market at a lower price to build your portfolio larger in the long term. But make sure you open a high yield savings account or HYSA and stash away 6 months or maybe even 12 months worth of expenses. And HYSA is perfect because the rate is 10 to 20 times greater than the national average for savings accounts. And the best part, a high yield account isn't any riskier than keeping your money in a traditional savings account. In fact, balances are federally insured for at least $250,000. So think of it this way. It's like having your cake and eating it too, except the cake is money and you're allowed to spend it unless it's an emergency. And now that we've got your cash reserve sorted, let's talk about something even more exciting, budgeting. But before you roll your eyes and click away, let me tell you why this is important to stay financially independent. So step number 6 is to calculate your monthly nut. And you're like, wait, what? What is a nut? Calculating your expenses is the most important thing you need to do to calculate your financial independence number. You have $10 million in your checking account, but you decided to invest $6 million of that in your brokerage account. So if you withdraw 4% of your $6 million investments, that's $240,000 a year. Can you live on $240,000 a year? If the answer is no, you've got some budgeting to do, because I know that's BS. And I know people who live on $40,000 a year, $50,000, $75,000 a year. If I ask you what your monthly nut is, can you tell me what it is? Google it and tell me in the comment section. If your financial independence number is 6 million, then you need that money invested so that it can last you a lifetime. Otherwise, you're going to end up going back to work one day and you're going to hate yourself for it. The term budgeting became an unpopular term for some reason because some people don't like to do it. And I'm a millionaire and I still budget once a week. Budgeting means that you're giving yourself permission to spend money. That's all there is to it. Next month, I'm going to spend $100 on stupid things because I'm debt free. So I'm giving myself permission to do it. People who become broke are the ones who do not budget at all. In other words, they have no plans to spend, save, or invest their money. You don't even have to be good at spreadsheets. You can download budgeting apps like YNAB, like I'm about to show you in this quick clip. So what do you think is better? Investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using the link in the description below. But anyway, now that you have this large sum of money, it's perfectly okay to increase your lifestyle expenses. Maybe you'll never fly coach again. Maybe you want to hire someone to clean your house. Maybe you want to hire someone to cook for you, or someone to do grocery shopping, or to save you time. These are the things that you still need to budget for, or you're gonna run out of money really fast. Now that we've got your spending under control, let's get down to the real nitty-gritty, your financial education. Because let's face it, you cannot just wing it when it comes to money. The truth is, if you don't understand how money works, you're going to lose it fast. So step number 7 is to always focus on financial education. It doesn't matter how much you make. It doesn't matter how much you bring in every single month. If you don't know how to manage, grow, and protect your wealth, it'll disappear before you even realize what happened. That's why financial education is not optional. It is survival. But before you start throwing cash at the stock market, crypto, or that can't lose real estate deal your barber swears by, educate yourself. Read books like The Millionaire Next Door behind me, The Psychology of Money, or Rich Dad Poor Dad by Robert Kiyosaki. Feel free to follow financial experts, but don't take every TikTok money guru at face value. And here's the thing, learning never stops. The economy shifts, new investment strategies emerge, and tax laws change. And if you're not staying informed, you're falling behind. Think of it like medicine. Would you trust a doctor who hasn't learned anything new since the 90s? Exactly. Still not convinced? Imagine trying to perform brain surgery after watching a 10-minute YouTube tutorial. Sounds ridiculous, right? You see, investing without proper knowledge is the financial equivalent of that. You might get lucky once, but long term, you're playing a losing game. And just when you think you've got it all figured out, let me introduce you to something that might sound boring, but trust me, it's crucial. Retirement accounts. Why? Because real wealth isn't just about making money, it's about keeping it. And step number 8 is to max out your retirement accounts. You're like, wait, hold on 1 second. I have $10 million. Why even bother with your retirement accounts? Because of the tax-free or tax-deferred growth. Millionaires and billionaires understand the importance of tax savings. Remember, it's about how much you get to keep in your pocket. You want your money to grow tax-free as much as possible for your future. So look, if you're not using a 401k, Roth IRA, and HSA, you're going to be leaving free money and massive tax benefits on the table. It's less complicated than figuring out your ex's mixed signals. First, if your job offers a 401k, contribute at least enough to get the full employer match. That's free money, even if you're going to quit your job. And I would max out that 401k as much as you can. Now, aim to max it out to $23,500 per year or $31,000 if you're above 50. Your contributions will lower your taxable income and your investments will grow tax deferred. You can also choose to do a Roth 401k for tax-free growth and withdrawals, but it's going to depend on the total income for the year. You may already be at the 37% marginal tax rate if that $10 million is considered a taxable income. Next, open up a Roth IRA, also known as individual retirement account. Think of it as the superhero of retirement accounts. You can contribute up to $7,000 per year or $8,000 if you're over 50. But here's where the magic works. Your money grows tax-free, and when you retire, you can withdraw it without owing a single penny in taxes. It's like planting a money tree that the IRS cannot touch. So what's the catch? You fund it with after-tax dollars now, but trust me, the long-term payoff is worth it. However, if you're gonna be above the Roth IRA income limits because of the wealth transfer, you're going to need to do what's called a backdoor Roth IRA conversion. And I have a video on my channel that you can check out. You click on wherever my video editor put the video. And finally, if you have a high deductible health plan, open an HSA because it's a triple tax win. Contributions are tax-free, your money grows tax-free, and qualified medical expenses are tax-free. And simply contribute $4,300 a year or $8,550 per families. And the bonus, after 65, it works just like a traditional IRA, meaning you can use it for anything. And trust me, with this approach, your future you will surely thank you. Now, you're probably thinking, what about investing? What do I even do with all this money? Don't worry, we're getting to that. But forget about the get rich quick. We're talking about the smart kind of investing. So you've got your emergency fund locked down and your retirement accounts in motion. Nice. You got your cash reserve. You got a nice bank that's backing you up. Now it's time to level up and play the long game. Open a brokerage account and start investing. This is assuming that you're going to do everything by yourself without a financial advisor. I would still encourage you to talk to someone to make sure you're doing the right thing. You can schedule a session with me by visiting firesightchat.com/consultation. But here's the secret sauce. Dollar cost averaging sounds fancy, but it just means investing consistently over time, no matter what the market's doing. Time in the market That's a gambler's game. But investing a set amount on a regular basis, that's how wealth is built. Why does this work? Because it keeps emotions out of the equation, whether the market is soaring or crashing. You keep investing, just like planting a tree. You don't dig it up every day to see if it grew, right? You water it, wait, and let time do its thing. And finally, let's talk legacy, because real wealth isn't just about you. It's about making sure your money outlives you. Generational wealth is the ultimate flex, turning today's success into tomorrow's security. Do it right, and one day, your great grandkids might be sipping some margaritas on the yacht, raising a glass to the legend that started all with you. You see, true wealth isn't just about what you have, it's about what you leave behind. It's about making sure your family thrives, and not just today, but for generations to come. You ever hear the terms new money versus old money, right? Buy real estate that grows in value. Set up college savings plans so that your kids never have to struggle with debt. Creating a trust that protects everything you've built. These are not just smart financial moves, they're acts of love. Think of it like planting a forest instead of just one tree. It takes time, patience, and care. But one day, your great grandkids, or maybe even just your grandkids, might be toasting to you from a beach, grateful for the life you've made possible. I want you to think beyond today. Your wealth can be the bridge to a brighter future for your children, their children, and beyond. Don't waste it on temporary highs. Invest in a future that will outlive you. I strongly encourage you to check out this video about the buy, borrow, die strategy that wealthy people use. And this has been another beast of a video, and I hope you got a lot out of it.